Hi, thanks so much for tuning in to this PQ Prime conversation about earnings, and we're talking to the management of Anand Rathi Wealth. The headline number, of course, is that the total revenues in the quarter gone by have risen by about 28%. The PAT has risen by 23%. For the full year, they have beaten their own targets, and they have done that consistently over the course of the full year. Joining me are the founder, Mr. Anand Rathi, as well as the Deputy Chief Executive Officer, Mr. Feroze, Azeez. Thank you so much, as always, gentlemen, for taking the time. I will start with you, Mr. Rathi. You've beaten your own targets for the full financial year. I think your target is to have a consistent growth of 20 to 25%, and you have beaten that consistently over the year. How would you sum up the years that has gone, and do you anticipate that the platform is essentially the same for the year that we are in right now?
Yes, I think you're right. First of all, I would like to thank my team and my customers to make it happen. In spite of being a difficult year, the last year, the markets have just not changed. They're at the same level. In spite of that, the amount of efforts put in, and our, big contribution is our philosophy of holistic philosophy of wealth management, which had withstood the test of time. In difficult times, if we can do so well, I think that gives us confidence that we are really customer-centric. We take care of their interest, and people are therefore willing to take, bets with us and keep the business grow. So I think, yes, you're right. We have grown beyond we started with a, guidance of 155 crores of total net profit, which we revised during the year to 165. And I'm very happy that we are now above 168 crores.
Absolutely. Feroze, you've summed it up, I think. You've said that it's a tough environment. You said this in the press release as well. Does it improve, do you think, in this financial year? I think it's a little bit better. We've got a little bit of clarity that things have moved past the rough stage. Hopefully that remains the case. What is your assessment at the start of the new financial year?
See, I think, Alex, like you rightly said, there is worst is behind us to our mind. Of course, quite a few people say it's going to be volatility will continue, but I think volatility has subsided. If you measure it numerically, the India Wix or the realized volatility has come down. Okay, last 1 year has been very, very tough because markets went to 18,000 3 times and came back to 15,000 odd again, of course, 3 times. So that's what is 1.5 year kept in store for us. The subsequent 1 year, to my mind, after a 1.5 year of time correction on Nifty and a 1,000-point correction on Nifty in terms of price, at the same period, these 50 companies have added 1,000 rupees to their book value in the form of earnings. I personally think markets, when you have the least hope, is when the probability of making money is the highest. So I think if not the 1 year, next 2-3 years are good. At least the median returns of Nifty, which are 11%, should be breached. That's our hope. Especially when you look at the rear view mirror, the performance has not been so great over the last 1.5 years. Now coming to our business specifically, because we as a business have this principle of a basic principle saying that risk is what you end up managing. Return is what you pray for. Because we are one of the wealth management outfits which measure risk numerically and take a client or a prospect through the journey of risk before the wolves come knocking on the door. Now, is why I think clients are more happy during worst times because they know what they've got into. And since we manage risk reasonably well and measure it in the form of beta, and we always take 50-60% risk of Nifty and still deliver close to Nifty returns, that has created a lot of client referencing because they think that clients think that their friends are safer with us. That's why we've been able to add 18% on the client base.
Do you think that growth is sustainable though? Because one would assume that, of course, there's significant headroom to grow in this space, considering the penetration. But what are the targets, if any, for client addition and for revenue and for profit in the new financial year?
I would like Sir to give the guidance.
Okay. Mr. Rathi.
Well, yes, Alex, I think, we are looking forward in the current financial year so well. And we think that our AUM should increase, which is about 39,000 crores close today, maybe 47,000 crores, about 18% to 20% growth in the AUM. Similar growth we expect in the revenues. And again, I think our target for the current year, PAT should be 205 crores. which is almost 21-22% higher than the this year's profit. So even on a higher base, which you have this year, we are projecting to get good results. I would say very good results for the current year as well.
Okay. And I'm sure we'll speak about that on an ongoing basis as we have.
Yeah.
My one question with regard to a challenge perhaps that you will face in communication that you have with clients is the regulatory changes with regard to the taxes on debt mutual funds. And I guess to a certain extent, there is parity in treatment of this instrument as other instruments are treated. But will it affect flows at all in your estimation in the incremental flows? And how have you measured the impact of this on your business?
Feroze.
Yes, Alex. I think firstly, is this a reasonable change or a important change in the debt fund space? The answer is yes. There's no denying that. But I think still there's no parity with FD because FD is income from other sources, interests. But when you look at capital gain, even the short-term capital gain has several provisions of set-offs. If a person has equities sometimes throw up losses. Like last year, they threw up losses. So you can use those to set it off against for the next 8 years. Of course, that requires immense amount of planning and most people don't end up doing that. That's my disclaimer to that statement. Now, does it impact Anand Rathi Wealth? The answer is no, not as much. Because if you see our asset mix, close to 50% is equity mutual fund, 10-12% is debt, and 30-odd% is MLDs or structured products and some work in progress, raw material, which gets aligned to these three products. It's just 10-12%. And in our belief, debt is something which we have the least kind of incomes because debt is already going to earn the client only 6-7%. Earning too much there is not right. So we have always had a low cost, no credit risk, no interest rate risk strategy. So we would earn very little on debt. So I don't think that will impact too much. But I think having said which, the industry is going to go through a lot of innovation because Section 50AA, which has already encompassed debt mutual funds, says that if you take the risk, you are okay. If you're not taking risk, you're buying just debt and taking a capital gain benefit on the long-term side, getting indexation, it's not right. If bonds and debentures don't get indexation, a bond wrapped into a mutual fund in the form of a target maturity fund, should it get indexation, is where this emanates from. I think the industry will try and make packaged products from a client standpoint to mitigate this tax change. Of course, there will be some impact, about a 0.5-0.7% decrease in the net yield post-tax on the debt side, in spite of innovation is expected.
Okay, so not a significant, so bottom line, not a significant impact on the business for you.
Yes, sir. Absolutely.
Okay. Now, we've spoken in the past about the raw materials for growth for Anand Rathi. Of course, this relates directly to the number of clients you have and number of feet on the ground. And you've also spoken about how the vintage of the advisors that you have has a bearing on the kind of business that you get. How do you anticipate, and you've already given me your guidance for the new financial year, but how do you anticipate that these different levers are going to move in the new financial year?
Yes, Feroze.
Yes, so you're absolutely right, Alex. So this is like a business which reaches inflection point at an RM level over a 4-year, 5-year period. Once an RM finishes 4-5 years of credibility in the same platform and does not move from one company to another, he has built credibility of a long-term relationship manager. Once that happens, then you have a hockey stick kind of a business movement. As our business progresses, out of the 290 odd RMs, which we have now from the 271, which we began the year, I think if I'm not wrong, almost about 130, 140 of them have finished 5 years. Now that's a large number. Now these guys have already become mature RMs, and we have seen that the growth, which is acceleration to the growth, becomes very, very high. That's point one. Point two is if 64% of our clients have finished 5 years, 6 years in the system, over the last 3 years, you've added 36%. Out of the total 8,500 clients, 36% are less than 3 years and 64% are greater than 3 years. So credibility at a client level is growing. Once credibility grows, they start giving references. So I personally think the 20-25% growth, which we always say is a conservative number, is derived out of 4 engines of growth: new clients, old clients, new money, and portfolio growth itself and new feet on street. I think one thing which didn't contribute for the last 1 year was markets catalyst. We didn't get a tailwind, but I think next year we should get a little better tailwind. And like Sir said, 205 PAT should be a number we should put all our energies to achieve and overachieve.
I think both your investors as well as my viewers will hope that your last statement comes true, both for their portfolios as well as for you. Thank you so much, gentlemen, for taking the time. Always a pleasure speaking with you.
Thank you, Alex. Thank you.